Hey there! Have you ever noticed how prices keep going up? For example, back in the year 2000, a burger price was around $2. But today, in 2024, that same burger may cost nearly $6. And it's not. Hey there! Have you ever noticed how prices keep going up? For example, back in the year 2000, a burger.
Every hour of every day.
Hey there! Have you ever noticed how prices keep going up? For example, back in the year 2000, a burger price was around $2. But today, in 2024, that same burger may cost nearly $6. And it's not just food. Back in 2000, a movie ticket was around $5. Now, you could be paying more than $10 for watching a movie in the same theater. So what's going on? Why do prices keep increasing? Why don't they just stay the same? Are sellers raising prices together on purpose? Actually, there's one big reason for this: inflation. You've probably heard this word
Every hour.
Hey there! Paying more are selling reason for this: inflation. Purpose? Actually, there's one big reason for this: inflation. You've probably heard this word before, but do you really know what it means? Why does inflation happen? Hey there! In 2025, US President Donald Trump imposed new tariffs on almost every country, especially on China. As of April, tariffs on some Chinese products have shot up to over 200%. But that's not all. Trump also accused China of manipulating its currency to make the yuan weaker and dodge those tariffs. You might wonder, why would anyone want their money to get weaker? Don't all countries want a strong currency? What China is doing might sound strange at first, but it's actually a strategic move called currency devaluation. Or is it manipulation? So what is currency devaluation or manipulation? Why would a country want a weaker currency? How do they do it? Is it fair? Is it cheating? Is a weaker currency really bad? And yes, we'll even talk about the famous Plaza Accord, where the US did it too. In this video, we will talk about everything you need to know about currency devaluation and manipulation. Section 1. What is currency devaluation and manipulation? Currency devaluation is when the government lowers the value of a country's currency on purpose. This is different from currency depreciation. Depreciation is when a currency weakens naturally. Like when a country's economy is not good, foreign investors lose confidence and sell that currency in response. So depreciation happens naturally due to market response, while devaluation is a choice made by the government on purpose. Then there's currency manipulation. Simply put, currency manipulation is when a government actively controls or influences the value of its currency. But not every time a country adjusts its currency is considered manipulation. Many countries, especially countries that export a lot, manage their exchange rates as part of normal economic policy. It only becomes controversial when countries are not transparent, or they push their currency down unnaturally for too long, making their exports unfairly cheap, at least according to others. That is when they might get labeled a currency manipulator. But it's more a political term, as there's no clear definition of currency manipulation. Now, you might be thinking, why would any country want a weaker currency? Isn't a strong currency always better? Well, let's talk about why countries sometimes choose to make their own money weaker. Section 2. Why would a country want a weaker currency? At first, it sounds like one of the dumbest things governments can do, right? Well, in macroeconomics, it can actually be a useful tool. First, cheaper exports for other countries. This is the main reason countries do currency devaluation. For example, let's say $1 equals 7 Chinese yuan. A Chinese factory makes a toy and sells it for 7 yuan. When they export it to the United States, the buyer pays $1 because $1 equals 7 yuan. Now imagine again, but this time the US government adds a 30% tariff on Chinese toys. That means the toy now costs $1.30 in the United States. Suddenly, it's no longer cheap. American customers might start buying toys from another country or from US factories instead. To fight back, China weakens its currency. Now, 1 US dollar equals 8 yuan. The same toy still costs 7 yuan, but when it's converted to US dollars, it becomes 88 cents. And after being slapped with 30% tariffs, it still costs $1.15. It makes the Chinese toys cheap again without needing to cut costs or sacrifice profit. Of course, a country doesn't devalue its currency like from 7 yuan to 8 yuan in one move that fast. They do it slowly, quietly, and carefully. And yeah, they're definitely not going to make any announcement if they want to devalue. Now, you might wonder, if the change is so small, why even bother? Well, because a country's exports can be worth billions of dollars. Even a small devaluation can make a huge impact. So by weakening its currency, China can cancel out part of the tariff and keep its exports competitive. And that's why Trump and many American exporters have complained that the dollar is too strong, which makes US exports more expensive and less competitive overseas. Second, more expensive imports or invisible tariffs. Wait, how are more expensive imports good? Well, if you watch my tariffs video, I mentioned that countries use tariffs to make imported products from other countries more expensive than local ones. So the local products now look more attractive to buyers because they are the cheaper option. But if your country puts tariffs on another country, that country will retaliate and put reciprocal tariffs. That is what happened in the Trump-China trade war. But by doing currency devaluation, you are doing the similar thing as what tariffs are doing. It's slower and less powerful, but it doesn't break any trade agreements and likely won't trigger retaliation. But yeah, just like tariffs, this can also cause inflation. Third, devaluation can somehow reduce debt's value. Let's say the Wee land government borrowed 1 million Wee dollars from its own people. Years later, the government prints more money and causes inflation. Now, because prices have gone up, the same 1 million can only buy half as much as before. But the government still pays back only 1 million. So in real terms, it's paying back cheaper money, money that's worth less now than when it borrowed it. This is how inflation, which caused by devaluation, helps shrink the real value of debt when the debt is in your own currency. But this only works when the debt is in their own currency. If they borrowed in foreign currency like US dollars, then it's the opposite. A weaker local currency makes the debt even more expensive to repay. Pretty sneaky, right? Speaking of protecting yourself from sneaky moves, there's something else you should be careful about: your own personal data. Thanks to today's sponsor, Incogni. Thousands of data broker websites gather your information, like your name, phone number, home address, and even the things you search online, often without your permission. So sneaky. If you want to get it deleted, you would normally have to email those companies one by one and fill out tons of papers, repeating the same things over and over again. That is where Incogni comes in. You just need to set it up once, and Incogni will contact those companies for you, requesting them to delete your personal data from those creepy databases. They will even keep following up until your data is wiped out and confirmed. All done automatically. So easy. And the best part? You can try it risk-free for 30 days. And don't forget to use my code EXPLAINS101 at checkout to get 60% off an annual plan. Just click the link in the description. And yep, there's a full money-back guarantee. Now let's get back to section 3. So how can countries weaken their currency? Do they just change the numbers on the exchange board? Well, not exactly, but they do have some methods to do that. The first method is cutting interest rates. This is actually done by the central bank, not the government. Yeah, they're different. As you know, when you buy government bonds, it means you are lending your money to the government, and the government will repay your money plus the interest based on the interest rates set by the central bank. For example, when interest rates are high in the US, it means investors can earn bigger returns by buying things like US government bonds or savings. But to invest, they need US dollars. So they buy dollars, which pushes up the demand and strengthens the US dollar. Now, how do you weaken the dollar? Just do the opposite. Cut the interest rates, which means the US government now can pay lower interest on bonds. Investors might lose interest and sell the bonds and US dollars. Less demand for the dollar eventually weakens it. The second method is printing more money. Oh yeah, the classic move. This is also known as quantitative easing, or QE. It's when the central bank prints new money and uses that money to buy government bonds from others, like commercial banks. Commercial banks that receive new money will lend more to businesses and people. This will cause inflation. As you know, inflation will cause the value of the currency to drop. The third method is using foreign reserves. That means the central bank buys or sells its own currency to push the exchange rate where they want it. In my video about why currencies have different values, I mentioned that more demand for the currency will increase the value as people are competing to buy it, while vice versa, less demand will decrease the value. For example, unlike the US where the dollar is allowed to float freely in the market, China doesn't fully let the market decide. The Chinese government sets a daily target exchange rate for the yuan. If not, then China will sell a huge amount of yuan in the foreign exchange market, which is the place where people buy and sell currencies. Or China can just let the yuan fall and do nothing. But if the yuan falls too sharply, China will use their massive foreign reserves, which are around 3 trillion US dollars, to buy back the yuan, increasing its price and making the yuan stronger again. This method is fast, but expensive, especially the strengthening part, as it needs tons of foreign reserves. Now we go to section 4. Is it fair or is it cheating? At this point, you might be thinking, wait, isn't this cheating? Can a country really just tweak its currency and get an advantage in global trade? That is exactly what the US accused China of doing. In 2019, the US Treasury labeled China a currency manipulator after the yuan weakened past 7 yuan per dollar. China denied it, but the US believed China was weakening its currency on purpose to offset tariffs. But there were no punishments anyway, and the US dropped the label in 2020. Actually, most countries manage their currency in some way. For example, back in 1985, the US faced huge trade deficits with other countries, especially Japan, which was the rising economic superpower. So the US pressured Japan, Germany, France, and the UK to meet at the Plaza Hotel in New York and agree to make the dollar weaker on purpose. It was called the Plaza Accord. How did they do that? For example, Japan sold huge amounts of US dollars from their reserves in exchange for their own currency, the Japanese yen. As more dollars flooded the market, the US dollar weakened. As the yen is less in market, but the demand for yen still same, so the yen's value shot up much faster than Japan expected. The strong yen made Japanese exports way more expensive overseas. Japanese businesses' profits fell. So to fight it, Japan cut interest rates and printed more money to give cheap loans to its population. The Japanese saw cheap loans, borrowed heavily, and invested crazily in stocks and real estate, which caused one of the biggest asset bubbles in history. The bubble finally popped in the 1990s and cost Japan's lost decades. Devaluation can help make exports cheaper, but it can also trigger retaliation. For example, after the 2008 financial crisis, many countries struggled to grow their economies. So one by one, their central banks cut interest rates, printed more money and let their currencies fall to boost exports. This sparked a currency war where everyone raced to weaken their money to stay competitive. The danger is when too many countries do this at once, it can cause global inflation, market panic, and broken trade relationships. So, is it fair? Depends who you ask. The country doing it says it's just protecting its economy. Other countries say it's unfair competition. And if all countries are doing the same, then no one wins. Section 5. Is weaker currency really bad? If a weaker currency helps exports, protects local businesses, and even somehow reduces debt, it sounds kind of smart, right? Well, a weaker currency does come with real consequences too. The first effect is inflation. When your currency weakens, importing things like food, oil, and electronics gets more expensive, and prices across the board start to rise. That is why countries like Turkey, which still depend heavily on imports, suffer badly from inflation when their currency fails. Meanwhile, countries like China, which produce more of their own goods locally, can survive better and even profit from exporting cheaper products. The second effect is eating your salary. If your salary stays the same or grows slowly while living costs rise faster, people suffer. You are technically earning the same, but in reality, you can afford much less. The third effect is the growing gap between the rich and the poor. When inflation is rising, many people are scared and start to invest more in assets like real estate and others to protect their assets from inflation. As people are competing to invest, asset prices are skyrocketing. Well, this is good if you have those assets, but for people who just rely on salaries, this makes them poorer, especially when the salary isn't even enough for living, let alone to invest. So in the end, the rich get richer and the poor get poorer. Also, countries cannot just keep weakening their currency forever. If inflation spirals too much, it not only hurts prices, but can destroy trust in the currency itself. Once people and investors stop believing a currency is stable, it becomes worthless. So, in conclusion, a weaker currency can make exports cheaper, protect local industries, and even help shrink debt. It's not always a bad thing. In fact, countries like China, Japan, and even Switzerland have used this strategy when it suits them. But it's not a free win. A weaker currency can also raise prices, hurt salaries, widen inequality, and trigger high inflation, especially if your country still depends heavily on imports. So, is it cheating? Is it smart? Or is it just survival in the world economy? The answer is all above. In the end, it's not just about strong or weak currencies. It's about who controls the money and who pays the price. If you want me to make other videos explaining these topics, please like and subscribe. Thanks for watching.
Hey there! If you watched my video on how the stock market works, you know I promised to explain more about investing and trading. So if you haven't watched that video, I recommend you watch it first. As I said in that video, you can buy stocks for trading or investing. But what's the difference? Both trading and investing involve the same action of making money from investment. The differences lie in the time period and the way to analyze the stocks. So, how do these two things differ from each other? Well, let's understand more about both of them. The first way, trading. As the word trading means buying or selling goods, then trading in stocks is the same. In the stock market, trading means buying stocks at a lower price and selling them at a higher price in a short period frequently. To trade effectively, you need to understand something called technical analysis. But what is technical analysis? I believe you have seen stock graphs many times, right? This is called a candlestick chart, and each candlestick represents the price movement of a stock. Basically, when the candle is green, it means the stock price is going up because more people are buying the stock than selling it. When the candle is red, the stock price is going down because more people are selling the stock than buying it. Candlestick charts are actually more complex than that, but in this video, I will keep it simple. Traders analyze these graphs to predict when and where the stock will fall, and when and where it will rise again. Technical analysis involves studying past price movements and patterns to forecast future price behavior based on the belief that historical patterns tend to repeat themselves. Let's get into an example. Let's say you want to buy a stock, and you see this graph. The golden rule of trading is to buy at a low price and sell at a higher price to make money. Using your technical analysis, you predict that at a certain point, the stock will stop falling and start rising again. Most traders wait until the graph shows signs of growth before buying. For instance, you buy one share at $10. Then you wait for the stock to grow, and let's say it reaches $13. You analyze the graph again and see signs that the stock will fall, so you sell your share for $13. Congratulations, you just made a $3 profit. As your prediction was correct, the stock falls to $11. You see signs again that the stock will rise, so you buy it at $11. The stock grows to $16, and you sell your share again, making a $5 profit. So, you might think trading seems like easy money, right? Well, the example I just told you is like every trader's dream because in reality, it's not that good. In reality, technical analysis is not 100% accurate. You're predicting when the stock falls and when it grows again. If your prediction is wrong, you lose money. In most cases, you might buy at $10, expecting it to rise, but instead, it keeps falling. To minimize losses, traders use a strategy called stop loss. Stop loss is when a trader sells the stock when the stock price has hit a certain price or percentage before it falls further. For example, if you have $10 to trade, you can only tolerate losing $2, you set a stop loss at $8. So, when your stock value drops to $8, you immediately sell the stock before it falls further. After doing a stop loss, the stock might fall a bit more and then rise again slightly. You may see this as a sign of recovery, so you buy again at $9, expecting it to rise. However, if the stock falls again rapidly and you have to stop loss again, you end up losing more. In this scenario, you lost $2 initially and another $3, totaling a $5 loss. And the another scenario is you buy the stock at $10 and the stock starts to rise. At $13, you see signs that the stock might fall, so you sell to lock in your profit. The stock falls a bit as predicted, but then it rapidly grows to $17. You've missed out on a much larger profit because you sold too early. So, while you made a $3 profit, you missed out on a potential $7 profit. So, trading involves a lot of risk and requires constant monitoring and quick decision-making. And there are also different types of trading, including day trading, which involves buying and selling stocks within the same day to profit from small price movements. Then, swing trading, which involves holding stocks for several days or weeks to profit from expected price changes. And position trading, which is a longer-term strategy where traders hold stocks for months, aiming to benefit from longer-term trends. You can trade in various markets like stocks, Forex trading, which involves buying and selling currencies. Commodity trading includes gold, silver, oil, and agricultural products. And also cryptocurrency trading, like Bitcoin, Ethereum, these meme coins, and others. And let's continue to the second way, investing. While trading focuses on short-term gains, investing is about building wealth over a longer period. As the word investing means buying assets that will grow in value and will generate income for you over time. If you've watched my video about how the stock market works where I explained the Sarah's Pizzeria case, that's also investing. In stock market, investing means buying stocks and holding them for an extended period, often years or even decades. Investors look for companies with strong fundamentals, believing that their value will increase over time. Additionally, some companies pay dividends, which means they distribute a portion of their profits to their investors regularly. Unlike trading, investing doesn't rely heavily on technical analysis, but focuses more on fundamental analysis. And what is fundamental analysis? Fundamental analysis evaluates a company's financial health and performance. This includes analyzing financial statements, such as the balance sheet, income statement, and cash flow statement. Investors look at metrics like revenue, profit margins, earnings per share or EPS, return on equity or ROE, and other metrics. By doing this, investors will know whether the company is growing, profitable, and worth investing in. Because no one wants to invest in a failing company. So, let's get into an example of investing. Let's say you want to start buying stock to invest, and you find a company named WeWe Shoes Corporation. You've done your research and believe WeWe Shoes Corporation has strong growth potential because they make high-quality, stylish shoes that have become increasingly popular. So you decide to buy 10 shares of WeWe Shoes Corporation at $50 per share, totaling $500. Over time, WeWe Shoes Corporation launches new shoe designs that go viral and captures the interest of many people. The company expands by opening new stores and boosting online sales, leading to increased revenue and profits. The company also pays a dividend of $2 per share annually. With your 10 shares, you receive $20 each year in dividends. The company's stock graph goes up and down, but overall the trend is still going up, and you still believe in the company as it continues to do well, as WeWe Shoes Corporation never stops innovating new styles of shoes, and everybody still loves it. After holding the shares for 5 years, the stock price rises to $150 per share, and you decide to sell them. Now your initial investment of $500 has grown to $1,500, giving you a profit of $1,000. Additionally, over the 5 years, you've earned $20 in dividends per year, which means you got $100 in dividends, bringing your total earnings to $1,100. Now, you might think investing sounds simple and like easy money. If it were that easy, why doesn't everyone do it? The truth is, investing takes time and patience. Even the most successful investor, like Warren Buffett, took decades to build his wealth. He started investing when he was 11 years old, became a millionaire at age 32, and a billionaire at age 56. Quite a long time, huh? That's why not everyone is willing to do long-term investing. As Buffett said, nobody wants to get rich slowly. Also, investing isn't limited to stocks. Other common markets for investing include bonds, which are loans to companies or governments, which will pay you interest over time. Then, mutual funds are like a big basket of different stocks and bonds managed by professional investors. When you invest in a mutual fund, you're giving your money to these professionals who will invest it for you. When they make a profit, they return some of that money to you, but they also take a fee for their services. Then, ETFs, or exchange-traded funds, work similarly to mutual funds, but you can buy and sell them on the stock exchange, just like individual stocks. Then, property investments that can generate rental income and appreciate over time. And cryptocurrencies, which are digital assets like Bitcoin, Ethereum, and these meme coins. So, in summary, both trading and investing involve buying stocks or other investment instruments, waiting for the price to grow, and then selling at a higher price. But the difference lies in the time period and the way to analyze. Trading is done in a much shorter time, maybe in hours, days, weeks, or months. Investing is done over a much longer time, like years, or even decades. For example, Warren Buffett has held Coca-Cola stocks since 1988, until this video is made, which is 2024. Then, trading focuses on technical analysis, which involves predicting price movements based on historical price patterns and trends. While investing focuses on fundamental analysis, like looking at a company's financial health, market position, and overall potential for growth. In trading, you don't need to care whether the company is profitable or whether the business is good or not. Just focus on the price movement. While in investing, you don't need to care whether the price is fluctuating up and down. Just focus on the company's performance that assures you it will grow well in the long term. Trading is more difficult, more stressful, and more risky. If your prediction is correct, you could get thousands of dollars overnight. But if your prediction is wrong, you could also lose everything overnight. While investing is more relaxed and less risky, you can buy your stock today and leave it for 1 or 2 or even 10 years without even checking on it, as long as you believe the company is still doing well. For example, if you bought 100 shares of Apple stock in 2008 for $300 when the price was about $3 per share and simply held it for 16 years, your investment would have grown to about $22,000 by 2024, when the price reached approximately about $220 per share. And some famous traders include Andrew Krieger, Paul Tudor Jones, Stanley Druckenmiller, and the controversial George Soros. In contrast, notable investors include the legendary Warren Buffett, Benjamin Graham, Peter Lynch, and Carl Icahn. And you might be wondering, which is better or more profitable? The answer is, it depends on various factors, including your financial goals, risk tolerance, and time commitment. If you want to make quick money and are okay with taking risks, trading could be a good choice for you. Trading usually means you need to watch the price movements all day to make the right decisions, so it often feels like a full-time job. Factors, including your financial goals, risk tolerance, and time commitment. If you want to make quick money and are okay with taking risks, trading could be a good choice for you. Trading usually means you need to watch the price movements all day to make the right decisions, so it often feels like a full-time job. But remember, it's important to really understand how the market works, and you have to be ready to accept losses when they happen. On the other hand, if you're looking for a more stable and less stressful way to grow your money, investing might be better for you. Investing allows you to put your money in and let it grow over time without needing to watch the market constantly. This approach is great if you have a busy schedule and can't keep checking prices. While it might take longer to see returns, the potential for steady growth can be rewarding in the long run. So, both investing and trading can be profitable, but both using different ways and risk tolerance. And before starting trading or investing, please make sure to learn as much as you can. Because if you don't have enough skills or knowledge about investing or trading, you will be a gambler who doesn't know what they're doing and will end up losing money. If you want me to make other videos explaining these topics, please like and subscribe. Thanks for watching.
Hey there! Most people know that investing is important, but you realize that lots of people avoid investing. The reasons are mostly not good enough at analyzing and choosing stocks or investments. Well, there's a solution to that worry, which is just investing in funds. You might have heard words like mutual funds, hedge funds, index funds, ETF, and all other funds. So in this video, we will talk about what is a fund, the types of funds, how does the fund work, and how to choose a fund for your investment. Let's jump in. Section 1. What is a fund? Even though a mutual fund, index fund, ETF, hedge fund, and other types of funds are different, they all have the same concept, which is a fund. Imagine you're hungry now and want to eat some snacks. You notice there's different types of snacks available, like cookies, candies, chips, and crackers, with each costing $2. But you only have $2, which is good enough to buy one snack. You also worry whether if you buy just one snack, will it taste good? If it tastes bad, then you just wasted your only money. So you ask 3 friends to put in $2 each. Now you have $8, enough to buy all the snacks. You and your friends can share and enjoy everything together. If the cookies taste bad, no problem. There are 3 other snacks to enjoy. That's the simple logic of funds. A fund is like a pool of money, where your money and other investors' money are collected and used to buy a variety of assets like stocks, bonds, cryptocurrency, and more. For example, let's say there's a fund company called WeWe Fund. WeWe Fund has $50 and decides to invest $10 each in 5 companies: Apple, Microsoft, Google, Tesla, and Nvidia. So each company then makes up 20% of the total portfolio. Now let's say you decide to invest $5 in WeWe Fund Your $5 gives you a fraction of the fund, which means your money is spread across all 5 stocks. So it means that your $1 of your $5 is invested in each of the companies. So by just buying one fund, you can own shares of these 5 companies. Sounds good, right? Of course, in reality, most funds hold hundreds to even thousands of stocks. For example, if you invest $1 into the Vanguard's VTI ETF, it means with just one transaction, your $1 can already own more than 3,600 stocks. So instead of buying stocks one by one, a fund can offer you like a big bag that's full of stocks. Some types of funds are managed by professional investors who handle everything for you. But of course, it's not free, and you need to pay a fee to the fund manager. But the good thing is, you don't need to do deep research and keep watching the stocks because someone is doing it for you. But wait, did I just say some types of funds have professional investors? Does that mean other types don't? Well, that's what we'll talk about in the next section. Section 2. Types of funds. As I mentioned earlier, you've probably heard of terms like mutual funds, ETFs, index funds, hedge funds, and more. But what exactly are they, and how do they differ? Let's break it down. The first type is mutual funds. A mutual fund pools money from many investors and is managed by a professional fund manager. The manager will decide how to invest the money by buying and selling stocks, bonds, or other assets to achieve the fund's goals. Mutual funds can be actively managed or passively managed. If mutual funds are passively managed, they're often called index mutual funds, which we'll explain in the next section. If the mutual fund is actively managed, then this means that the fund manager monitors investments daily, aiming to maximize returns or minimize losses. And of course, this daily monitor is not free. They charge annual fees called expense ratios, which range from 0.5% to 1.5% of your investment. For example, if you invest $1,000 in a mutual fund with a 1% expense ratio, you'll pay $10 per year, and you must pay the 1% expense ratio every year, even though your investment grows or even drops. However, mutual funds don't trade on stock exchanges like individual stocks. You can only buy or sell mutual funds after the stock market closes, and the price is set based on the day's closing value or the last value before the stock market closes, which is called the net asset value or NAV. And also, mutual funds often have a minimum investment requirement, which can vary. For example, most actively managed mutual funds might require around $500 to $5,000 to invest. And that's why actively managed mutual funds are not really friendly to beginners. Some of the famous actively managed mutual funds are Vanguard's VP Max, Fidelity's FBGRX, T. Rowe's TRBCX, and much more. Now, the second type is index funds. If most mutual funds are actively managed, index funds are passively managed. Index funds are designed to match the performance of a specific index. So, what is an index? It's a list or group of investments, usually based on their size, sector, or other criteria. For example, the most famous index, which is the S&P 500 index, includes the 500 largest companies listed on US stock markets like Apple, Microsoft, and Amazon. If you invest in an S&P 500 index fund like Vanguard's VFIAX, your money will be used to buy stocks from all 500 companies in the index. The index fund manager doesn't care whether the companies are good or not. As long as it's in the S&P 500 index, then they'll just buy the stocks. If, let's say, a company named ABC Company, which is listed as the 500th biggest company in the S&P 500, then the index fund will buy all companies in S&P 500 list, including ABC Company stock.
Monkeys have
If the
one
ABC
banana,
Company got replaced by DEF Company and it went down to 501st place, then the index fund will just sell the ABC Company and use the money to buy DEF Company. So why do people buy index funds? because
magnetic
they're
fields,
easy to
very
understand.
expensive
For
bills,
example,
and
the S&P
electric
500
arcs.
index
Take
represents
this simple
80%
circuit with
of
a
the
battery,
total
a
US
switch,
stock
a
market
lamp,
value.
and a wire
So if
connecting
you
them
believe
all
that the
together,
US economy
the
will
battery is
continue to
adding
grow,
energy to
you
the
might
circuit,
invest in
and the
an
lamp is
S&P
removing
500
this,
index
transforming
fund.
it into
Or
light and
if you
heat.
think that
You can
technology
flip the
companies
switch
will
to
perform
control
well,
this.
you
What's
might
happening
choose
is
a
tiny
NASDAQ
particles
100
called
index fund,
electrons are
which
moving
focuses
through the
heavily
wire
on technology
from the
companies.
battery's negative
Because
terminal
index funds
through
are
the lamp
passively
and
managed,
into
which means the fund managers are not watching the market every time, their fees are usually very low, mostly under 0.5%, which is great if you're on a budget. Index funds can come in two styles, as mutual funds or ETFs. If the index fund is in a mutual fund style, it's just the same as mutual funds, which can only be traded after the stock market closes. The difference is only the index mutual fund is passively managed and just follow the index list. Famous examples of index mutual funds like Vanguard's VFIAX, Fidelity's FNILX, Schwab's SWPPX, and much more. And how about the ETF style? Well, we'll talk about it in the next part. The third type is ETFs, or Exchange Traded Funds. An ETF is a type of fund that can be bought and sold on the stock exchange during trading hours, just like individual stocks. You can buy or sell ETFs anytime using a stock trading app, and most ETFs have minimum investment requirements as low as $1 or 1 share, depending on your stock trading app and broker. This makes ETFs very beginner-friendly and easy to use. ETFs come in two styles, actively managed and passively managed. However, most ETFs are passively managed, like index funds that follow a list of companies based on specific categories or performance. That's why, when people talk about ETFs, they're usually referring to passively managed ones. Some examples of passively managed ETFs include Vanguard's VOO, which follows the S&P 500 index. So if you want to invest in the S&P 500, you can buy Vanguard's VOO. Don't like VOO? No problem. There are plenty of other ETFs that also follow the S&P 500. You can also invest in Invesco's QQQ, which tracks the NASDAQ 100 index and focuses on technology companies, or Vanguard's VT, which invests in both US and international stocks. There are even ETFs like VanEck SMH, which focuses solely on semiconductor companies like TSMC and Nvidia. Some ETFs even invest in cryptocurrencies like Bitcoin. Interesting, right? As mentioned earlier, there are also actively managed ETFs, such as ARK's ARK, Fidelity's FBCG, and T. Rowe's TCHP. And you might notice the expense ratio is higher because it's actively managed. Then the fourth type is hedge funds. A hedge fund is just like a mutual fund, but for the ultra-wealthy and experienced investors. While mutual funds might require a minimum investment of $500 to $5,000, then hedge funds often have minimums from $100,000 to several millions of dollars. Not only that, hedge funds are very aggressive. They take bigger risks in hopes of higher returns. This can include investing in complex investment strategies, short-selling stocks, or even betting against the market. Because of this, hedge funds are usually actively managed. Some examples of hedge funds are Bridgewater Associates, Citadel, and Millennium Management. Well, those are the explanations of the 4 common types of investment funds. To wrap up, here's a summary table comparing these funds. Feel free to take a screenshot. Now, let's continue to the next section. Section 3. Which fund is the best? After learning about these 4 types of funds, you're probably wondering which fund is right for you. Which one can make the most money? Let's find out. First, let's talk about convenience. If you want something flexible and easy to trade, ETFs might be your best choice. You can buy and sell them during stock market hours, just like individual stocks using a trading app. If you're looking for an easy-to-use trading app, Moomoo is a great option. It's an online platform where you can trade stocks and ETFs with low fees. Plus, if you sign up through the link below, you can get up to 15 free stocks when you make a deposit and earn an 8.1% APY on your idle cash. On the other hand, Mutual funds, including index mutual funds, can also be traded using stock trading apps, but they are less flexible since they're only priced at the end of the trading day, so you cannot trade instantly like ETFs. But if you're not a fan of seeing your investment go up and down throughout the day, mutual funds might offer peace of mind. Hedge funds, meanwhile, are for ultra-wealthy, experienced investors and are not publicly traded like ETFs and mutual funds. Next, let's discuss minimum investment and expense ratio. If you're starting small, ETFs are perfect as they have no minimum investment requirements and the lowest expense ratios. Mutual funds are good too, but often come with higher minimums and expense ratios. Hedge funds? Unless you have thousands or millions to invest, they're probably out of reach. Finally, let's talk about performance, the most exciting part. You might think actively managed funds or hedge funds deliver the best returns, right? Well, in some countries it might be right, but in the US, the data shows that passively managed index funds or ETFs often outperform many actively managed mutual funds and hedge funds in the long term. Wait, what? That sounds illogical, right? How can simply following a list of indexes beat professional fund managers? Well, before we continue, it doesn't mean that passive index funds, or ETFs, always beat the actively managed mutual funds and hedge funds. As you can see here, some actively managed funds still beat the passive index funds. But there's also a significant number of actively managed funds that underperform the passive index funds. So why does this happen? Well, the reason is that beating the market or performing better than everyone else in the investment world is extremely hard. Actively managed mutual funds and hedge funds can indeed outperform index funds and ETFs, but most of them struggle to do so consistently. On the other hand, passively managed index funds and ETFs aim to grow slowly but steadily over time. And also, the higher expense ratios or fees of actively managed mutual funds and hedge funds, they can add up over time and reduce your overall returns, especially if their performance isn't strong. Meanwhile, passively managed index funds and ETFs, with their super low expense ratios, have minimal impact on your investment. So, actively managed funds can offer higher returns but with higher risk, while passively managed funds offer lower returns but with lower risk. So in conclusion, you now know what funds are, how they work, the different types available, and how to choose the right one for your investment. Funds are a great option for beginners and experienced investors alike because they simplify investing, offer diversification, and can be used to reach your financial goals. And remember, every investment has risks. Always do thorough research before making any investment, whether in mutual funds, index funds, ETFs, or hedge funds. If you want me to make other videos explaining these topics, please like and subscribe. Thanks for watching. Hey there! So you want to invest and get rich. Great! But now your portfolio is red, minus. Every time you check, it's worse. The news screams about crashes, recessions, and corrections. But what does it all mean? Should you panic, buy more, sell everything, or just close the app and cry? Before making any moves, remember that many market crashes in history have created new millionaires. This might be your chance to become rich. What? Really? Then how do you do it? Before we start, let's first understand, why do stock markets crash? Is this normal or should you be worried? How do you survive a crash? And most importantly, how do some profit while others lose everything? In this video, we'll cover everything you need to know about stock market crashes. Let's get started. Section 1. Why do stock markets crash? To understand stock market crashes, we first need to know why they happen. A crash is when the stock market suddenly drops fast, meaning many stocks fall sharply. This usually happens for 3 reasons: bubble bursts, bad economy, and black swan events. Let's break them down. The first is bubble bursts. You've probably heard the word bubble thrown around in the stock market. But what does it actually mean? A bubble happens when stock prices go way higher than they should, usually because of hype, not real business growth. And when investors realize this, they all sell the stocks, and the stocks' prices drop hard. A real-world example is the dot-com bubble in the early 2000s. The internet was the new hype, and investors threw money at any company with .com in its name, even if it had no profits and no real business model. At its peak, over 400 internet companies went public, and the Nasdaq, the tech-heavy index prices, jumped by over 800% in total. But when people realized most of these companies were not making money, the investors sell all their stocks, and the bubble popped. The Nasdaq, a tech-heavy stock index, crashed nearly 80%, wiping out trillions of dollars in market value, and needed 15 years to return to its original price before the bubble. That's how bubbles work. Hype inflates prices, reality pops them. Then, the second reason is a bad economy and certain policies. Bad economic condition, like when inflation is too high, makes food and rent more expensive. People cut back on spending, which means businesses make fewer sales. When a company earns less, investors expect lower profits in the future, so they sell the stock and the price goes down. If this continues, it can lead to a recession when the entire economy shrinks. Production slows down, spending drops, and investors panic, causing the stock market to fall even further. That's why recessions are often linked to stock market crashes. Sometimes certain policies can also cause crashes. When the inflation rate is too high, the central bank raises interest rates to slow down the inflation, making loans more expensive. Businesses that need money are struggling, so they cut production. People start saving money and spend less, which spreads panic and pushes stocks down even more. And that's why every time this guy announces interest rate changes, investors are worried. If rates go up, loans get more expensive for businesses, and stocks usually drop. If rates are cut, loans get cheaper, businesses have more money, and stocks usually rise. The third is black swan events. Black swan is just another name of unexpected disasters, like wars, pandemics, terrorist attacks, financial scandals, and more. These kinds of shocks make people worry about the economy, which makes people get scared and sell their stocks as fast as possible, causing prices to crash. A real example is the 2020 COVID-19 crash. Nobody saw the pandemic coming, and within weeks, global markets fell by over 30% because investors panicked about businesses shutting down and the world economy collapsing. So these three are the main reasons behind a stock market crash. Of course, there are other factors too, like too much leverage, margin calls, or even herd behavior. But we won't go deep into those, since I want to keep this video simple. Now we know why stock markets crash, but the real question is this normal or should you be worried? Let's find out in the next section. Section 2. Are stock market crashes normal? Yes, stock market crashes are normal. The stock market doesn't just go up all the time, it moves in cycles with ups and downs. If you're investing for the long term, you need to understand that crashes are part of the game. In fact, for traders, these ups and downs are opportunities for them to buy low and sell high. Because if stocks only went up, everyone would just invest long term instead of trading. Believe it or not, history shows that the market follows a repeated pattern of market downturns. The first is pullbacks, when stock prices fall around 5 to 10%. This happens almost every year and is considered normal market movement. The second is corrections, when stock prices drop 10 to 20%. As the name suggests, corrections happen when investors realize that the stock prices are overpriced and corrected back to their fair prices, usually every 1 to 2 years. The third is bear markets, when stock prices fall around 20 to 40%. This usually happens every 5 to 6 years, often due to economic slowdowns or rising interest rates, because the economy isn't always good like a fairy tale. And the last is crashes, when stock prices drop 40% or more. These happen about once every 10 to 20 years, usually due to black swan events like financial crises or global disasters. So this is the table of differences. Feel free to take a screenshot. History has proven again and again that the market bounces back and even gets stronger after every crash. In 1973, the oil embargo crash sent markets down by nearly 50%, and it took about 7 to 10 years to fully recover. During Black Monday in 1987, the New York Stock Exchange crashed 22% in one day, but recovered in 2 years. During the 2008 financial crisis, the S&P 500 crashed nearly 50%, but eventually recovered in 4 years. During the 2020 COVID-19 crash, the New York Stock Exchange dropped 30% in just 5 weeks, but fully recovered in 4 months. Different crashes, but the same pattern. Market falls and come back even stronger. So, who lost money? Those who panicked and sold. And who made money? Those who stayed calm and held strong stocks. But some people still panic and say historical performance doesn't guarantee future results. What if this time the crash is different and never recover? How do we know? That's not completely wrong, but there are indicators to help you know when a crash is just part of the cycle and when you should actually be worried. Crashes are normal if you see the businesses are still operating. People still can spend and do leisure, and some actions have been made to stabilize things. Then the crashes most likely will recover. But this mainly applies to big, stable economies like the US. In smaller or unstable countries, crashes can take longer or recover differently. So you need to understand your country's condition. You should only start to worry if the entire economy breaks down. Like if businesses keep failing, banks go bankrupt, people can't access their money, and the country defaulted on its debt. Those situations are extremely rare, but if they happen, then yeah, that's the kind of crash that's much harder to bounce back from. Now you understand which crashes are normal and which ones are not. So your next question is, how to survive during stock market crashes? Well, let's find out in the next section. Section 3. How to profit from a stock market crash. A stock market crash might seem like the worst time to invest. You might be wondering, how do you even survive it? But here's the surprising part. Many people actually make huge profits during a crash. For smart investors, a market crash is one of the best opportunities to build long-term wealth. Like Warren Buffett said, be greedy when others are fearful. So how do you actually do that? Let's go through some common mistakes and what you should do instead if you want to profit during a crash. The first mistake is panic selling. When people see their portfolio turning red, their first instinct is to sell everything before it drops more. But here's the truth. You haven't lost money unless you sell. A stock might be down, but it still has a chance to recover. But if you sell at a loss, that loss becomes real. If you invested in strong, profitable companies, there's usually no reason to sell just because the market is down. Instead of panic selling, stay calm, stay informed, and focus on the long term. The second mistake is trying to time the bottom. Some investors try to predict the lowest point of a crash and wait for the perfect moment to buy. But the problem is, how accurate can you predict the lowest point? Many people wait too long and miss the lowest point, while others buy too soon, thinking prices won't drop further, only to see them fall more. Instead of guessing, a better strategy is dollar cost averaging, or DCA. DCA means investing a fixed amount regularly. So you buy more when prices are low and less when prices are high. This removes the stress of trying to time the market, and as long as you buy strong, profitable companies, DCA should be a worry-free approach, as long as you're confident in the company's long-term strength. The third mistake is buying bad stocks just because they're cheap. If you noticed, I keep emphasizing buying strong, good, and profitable companies. Why? When stock prices crash, it's tempting to buy anything that looks like a bargain. But not all companies recover. Some businesses fail completely and their stocks never bounce back. That's why it's so important to focus on strong, profitable companies. Those with low debt, solid earnings, history of surviving tough times, and good prospects. During a crash, great companies become cheap not because they're bad, but because everyone's panicking. For example, before the 2008 financial crisis, Amazon stock was at around $90 per share. If you had $1,000, you could only buy 11 shares. When the crash happened, Amazon dropped below $40 per share. Now, with that same $1,000, you could have bought 25 shares instead. If you had done your research and believed Amazon was a strong, profitable company with good future prospects, you could have bought it at that price. A few years later, Amazon rebounded and skyrocketed, reaching over $3,000 per share by 2021. That's over 8,000% growth. That means those 25 shares from the crash would have been worth over $75,000. And if you're interested in investing, Moomoo is a good platform to try. Click the link below to get up to 15 free stocks when you deposit and enjoy 8.1% APY on idle cash. Then the fourth mistake is not diversifying. Some investors put all their money into one stock or sector, thinking it's a sure bet. But when a crash happens, some industries fall harder than others. Smart investors spread their investments across different sectors like tech, healthcare, consumer goods, and utilities, so that if one area crashes, others can help balance the losses. Some even diversify into non-stocks like bonds, commodities, or international stocks to protect against stock market crashes. If picking individual stocks sounds hard, then you can consider buying funds like ETFs or index funds, which make it easier by automatically spreading your investment across multiple stocks. This way, you don't have to pick individual companies yourself. If you want to understand more about funds, check out my other video about ETFs, mutual funds, and index funds. Link in the description. The last mistake is FOMO, or fear of missing out. When panic spreads, people blindly follow what others are doing. If everyone is selling, they sell. If the news is predicting doom, they believe it. But even legendary investors like Benjamin Graham and Peter Lynch have said that even Wall Street professionals cannot predict the market perfectly. So make sure you understand what you're buying by doing your own research. And if you're still unsure, it's totally okay to speak to a financial advisor. But either way, you should always understand what you're investing in. Never blindly follow anyone, not even the pros. Like Warren Buffett says, never invest in something you don't understand. Now those are the common mistakes and smart actions for beginners. But there's one more strategy that some professionals use to profit from a crash, which is called short selling. It's when you bet that a stock's price will drop. For example, imagine your friend owns a stock worth $100. You borrow it, sell it for $100, and wait. If the price drops to $70, you buy it back, return it to your friend, and keep the $30 difference. But if the stock rises instead, say to $120, you'd have to buy it back at a loss. Some legendary investors made billions shorting the market, but it's extremely risky. That said, I'm only explaining it for knowledge. I don't recommend it, especially if you don't fully understand how it works. So, in conclusion, a stock market crash feels scary, but it's just part of the cycle. Historically, the US stock market has always recovered and even reached new highs after crashes. While no one can predict the future, past patterns show signs that recovery is likely unless the economy completely collapses. The key to surviving and profiting from a crash is staying calm, avoiding panic selling, doing thorough research, and buying quality stocks at a discount. Panic sellers lose, but smart investors turn crashes into their biggest wins. So, when the next crash happens, don't fear it, but be ready. If you want me to make other videos explaining these topics, please like and subscribe. Thanks for watching. Hey there! If I asked you to name the countries with the biggest economies, you'd probably say the US, China, Germany, India, Japan, and other big countries with big economies. But have you ever wondered, how do we actually know this? How do we know which country has the biggest economy? Which is the richest? Or how Germany, with just around 84 million people, can have a larger economy than many countries with more land and a bigger population? Well, we can know all this from something called GDP. I believe you've heard of GDP before, but have you ever wondered what it is? In this video, we'll talk about what GDP is, how it's measured, what GDP per capita is, some pros and cons, and how to increase the GDP. So let's get started. Section 1. What is GDP? The word GDP stands for Gross Domestic Product. Gross means total or overall. Domestic means it happens within a country's border, and product means goods and services. So GDP is the total value of final goods and services produced within a country in a specific time period, usually a quarter or a year. For example, if your country were a bakery, GDP would be the total revenue of all the bread, cakes, and cookies baked and sold in that bakery over a year. But the flour used to make the bread and cakes wouldn't be counted as GDP because it's already included in the value of the finished bread and cakes to avoid double counting. So GDP counts all final products and services made within a country's borders in one quarter or 1 year. Now, if a country primarily sells raw materials and cannot make the finished products, those raw materials are the final products and counted in the GDP. For example, again, if your country were a bakery and can only make flour but cannot make bread, the flour produced in that country can still be counted in the GDP. However, because flour is cheaper than bread, the GDP of that country will be lower than a country that can make finished products like bread. Also, it doesn't matter whether they're made by locals or foreigners. As long as the production happens within the country, it's included in the GDP. For example, if Bob, an American citizen, opened a bakery in the United Kingdom, the bakery's value would not be counted in the US GDP because it's in the UK. Instead, it would be included in the UK's GDP because the production happens there. Well, pretty simple and easy, right? Now, how to calculate all GDP? Well, we'll talk about it in the next section. Section 2. How is GDP measured? Well, GDP can be calculated using 3 methods. The first one is calculating the production. This method calculates the total value of all final products and services that are produced in the country. The second is calculating the spending. This method calculates the total value on how much money is spent in the economy. The formula is GDP equals to consumer spending, which includes everyday spending by normal people like you. For example, if you spend $100 on groceries, that $100 is counted as part of GDP. Then plus investment, which is businesses investing in themselves. For instance, if a factory buys a new machine to increase production, this is counted as investment. Then plus government spending, which includes all spending by the government, such as building a new bridge. The cost of materials, worker salaries, and other expenses involved in the project are included in the GDP. And the last is net export. So exports are when a country sells products to other countries, while imports are when a country buys products from others. The logic is simple. Countries aim to sell more or export than they buy or import to make money. So net export is calculated as exports minus imports. If a country exports more than it imports, it makes more money, which is included in GDP. The third method is calculating the income. This method looks at the total income earned from producing goods and services. It includes salaries, business profits, rents, taxes, and any other types of income, while subtracting any subsidies provided by the government, and the result is the total GDP. While the methods are different, if they calculated correctly, it should lead to the same result. A simple example, if a bakery produces 10 loaves of bread, then by calculating the production, the 10 loaves of bread times the average price of bread, which let's say is $3, so the GDP is $30. Now, if you calculate the spending, when let's say there's 10 people buying the bakery's bread, each one, so all people buy 10 loaves of bread for $3, which is also $30 as GDP. And if calculating the income, as there's 10 people each buy one loaf of bread for $3, then the bakery's income from selling 10 loaves of bread is $30, which is the GDP. See, all methods are giving the same result, $30, even though they're using different ways. Okay, you've understood how GDP is calculated, but now you're wondering from the previous example, if a bakery produces 10 loaves of bread, then the GDP is 10 loaves of bread times the average price of bread, which is $3 per loaf, which is $30. Now, the problem is inflation happens every time, and bread prices increase due to inflation. So is the GDP increasing while there's still 10 loaves of bread? Well, due to this problem, it makes GDP has two types that differentiates, which are nominal GDP and the real GDP. It may sound confusing, but don't worry, I'll explain it as simple as I can. The first is nominal GDP. Nominal GDP is calculating GDP using the current price. No need to worry about inflation. For example, if a bakery produces 10 loaves of bread in 2024, and the average bread price in 2024 is $3, then it means that the bakery is contributing $30 to the GDP. Now, if that bakery still produces the same 10 loaves of bread in 2025, and the average bread price in 2025 is, let's say, $4 per loaf, then it means the bakery is contributing $40 to the GDP. See, the GDP is increasing from $30 to $40, but the bread production is not. That's why most people say nominal GDP is not accurate, because it shows the economy is growing, but actually it's not due to inflation. And that's where real GDP comes in. So instead of using the current price that keeps increasing due to inflation, real GDP just uses a specific year price to calculate the GDP. For example, you might calculate real GDP based on the 2024 price. So in 2024, the bakery produces 10 loaves of bread, priced at $3 in 2024, so the GDP is $30. And in 2025, the bakery still produces 10 loaves of bread with $4 price in 2025. But we ignore it and still counted using the 2024 price. So the GDP is stuck at $30. See, now we know that the bakery didn't increase its production. So this is why the real GDP is more accurate. So now you have understood how the GDP works. But now you're wondering, how can we use the GDP to compare countries' economies when every country has its own size and condition? Well, we'll talk about it in the next section. Section 3. How to compare GDP between countries. When we compare the economies of different countries, looking only at their total GDP might not give us the complete picture. There are better ways to make this comparison clearer and fairer. First is GDP at purchasing power parity, PPP. You may have seen GDP at PPP mentioned on sources like Wikipedia, but are you wondering what this is? Well, let's see an example. Imagine both India and the US each produce one loaf of bread. In India, the price of one loaf is 100 rupees, so India's nominal GDP for bread would be 100 rupees. In the US, each loaf costs $3, so the US nominal GDP for the same loaf of bread would be $3. However, we can't compare rupees directly to dollars, so we need to convert the prices using the exchange rate. Let's assume the exchange rate is $1 equals to 100 Indian rupees. India's nominal GDP for bread in the US dollar would be $1, while the US, which produces the same one loaf, has a GDP of $3. So to make a fair comparison, we use the PPP ratio, which is 3 to 1 in this case, meaning one loaf of bread in the US equals 3 loaves of bread in India. So to adjust for this difference, we multiply India's nominal GDP of $1 by 3, giving India a GDP PPP of $3. As GDP PPP uses USD, so the US GDP PPP would be the same. So PPP helps us compare countries with different prices and exchange rates. Of course, counting PPP is much more complex than that, but I'll keep it simple. Second is GDP per capita. Let's compare Singapore, a small country with about 5 million people, to its neighbor, Indonesia, which has around 280 million people. Indonesia's total GDP is much bigger than Singapore's because Indonesia has more people. But why do people say Singapore is richer than Indonesia? This is where GDP per capita comes in. It divides a country's total GDP by its population, giving us an average value of how much economic output there is for each person. In 2025, Singapore's GDP per capita is around $93,000 for nominal GDP and $153,000 for GDP at PPP. Meanwhile, Indonesia's GDP per capita is around $5,000 for nominal GDP and $17,000 for GDP at PPP. This shows that, on average, each person in Singapore produces more economic value than each person in Indonesia. But because Indonesia has a larger population, its total GDP is higher. It's important to remember that GDP per capita is not the same as salary. GDP per capita is simply the country's total production divided by its population. You can see how different this is from average salary levels. A high GDP per capita usually suggests a higher standard of living, but it's not always true. We'll explain why in the next section. Section 4. Pros and cons of GDP. For now, GDP gives a broad picture of a country's economic activity. By looking at GDP, you can see the total value of goods and services produced in your country. And by comparing it with previous GDP numbers, you can tell whether the economy is growing or shrinking. Governments and central banks use GDP to check how healthy the economy is. For example, if a country's real GDP drops for 2 quarters or 6 months in a row, it could mean a recession, a term you might have heard a lot from the news. If the recession continues for 3 or more years, it could become a depression, like the Great Depression in the US during the 1930s. Many other economic conditions can also be understood from GDP. But of course, GDP is not perfect, as it still has lots of disadvantages and flaws. First is GDP doesn't count informal activities. Unpaid work like volunteering and other informal activities like illegal activities, which can value billions of dollars, are not included in GDP calculations. The second is GDP distortion. GDP includes foreign production within a country, and sometimes this number is inflated due to tax haven activities. For example, foreign companies move and register their profits in Ireland for tax benefits. These profits were counted as Irish GDP, but the companies immediately sent the money back to their home countries. This means Ireland, and especially the Irish people, don't really benefit from the high GDP, as the money was just passing through. You can learn more about this in my video on tax havens. The link is in the description. The third is not representing the quality of life. GDP only shows total country economy production, so it couldn't really show whether the people live well. For example, a country like Equatorial Guinea has PPP GDP per capita around $17,000 in 2023, according to the World Bank, which is one of the highest in Africa. You might think Equatorial Guinea is rich, but actually its high GDP is due to oil production that's controlled by the government. While the people, about 70% of the population, live below the poverty line and get no benefit from the oil economy due to massive corruption and unequal distribution. That's why GDP or GDP per capita doesn't